Good afternoon, everyone, and welcome to SVA's webinar number 2 of 4 on succession planning. I'm Nancy Melberg, a principal at SVA, and I'm glad you could join us for today's discussion. Whether you're planning to sell your business in the near future, transitioning ownership internally, or just want to build a strong and more valuable company, today's discussion should help you think strategically about the process. One of the biggest misconceptions we've seen is that an exit plan begins when an owner decides they're ready to leave the business, when the reality is the most successful transitions are a result of years of intentional planning. So today we're going to walk through the key areas that impact business value, buyers' confidence, and long-term flexibility, while sharing practical ways owners can reduce risk and position themselves for better outcomes. To present today, I have my colleagues, Nikki Grolup and Craig Maternowski, both principals with SVA and both certified exit planners. They both bring years of experience helping business owners strengthen their companies. So with that, I am going to kick it over to Craig.
Well, thank you, Nancy. So why early planning improves exit outcomes? So this can be summed up really in one word, and that is time. We need time, and that time is needed because exit planning is a process. It's not a single event. And sometimes the process takes 3 to 5 years, maybe even up to 10. So last time we discovered that up to 80% of a small business owner's net worth could be tied into the business. So we need time to improve that enterprise value. So I like to think of this process in 3 categories or 3 buckets. So the first is discover or self-assessment. And it's basically first step is to look at what my investments are outside of the business. Where am I at? Next step is to look at my business and see what the value of that business is. Then I need to determine how much I need to retire and then what my shortfall is. Once I find that out, I can go to the next stage, which is to prepare. So the first step is to prepare a separate personal financial plan, and at the same time doing a business improvement plan. And that's where we come into the picture. And so both of these entail doing consecutive 90-day action plans until we decide we're ready to go to the next category, which is to decide. And that decision is, do we keep it or do we sell it? Or like that TV show, love it or list it. Okay, now a little bit deeper dive into the category number 1. So is my company going to be attractive to a potential buyer? Is my company ready to sell? We determined last time that up to 80% of a company's value can be tied into the intangibles. So those 4 intangibles are 4 C's: the human, structural, social, and customer capital. So we're going to have a self-assessment on this and determine where we fall in the range. If we score high in these departments, then our multiple will be higher. If we score low in these departments, then our multiple will be lower. And also we can provide some guidance with that through our value builder report. All right, so the next step is to determine what is the value of the company. It is the recasted EBITDA times the multiple equals the company value. Next step is to determine what our wealth or asset gap is, which is determined by our wealth goal minus our outside investments equals this is what I need to get from the sale of my company in order to retire in a lifestyle that I wish. Okay, on to the next category. So we're going to run these 2 paths at the same time concurrent. The personal financial path, that should be run by a financial advisor to see about your outside investments and optimizing that. The next one is the business plan, and that's where we can help. The first step is going to be to de-risk the company or mitigate risk. And we do this first because that's where the low-hanging fruit is, right? That's the easiest. So this is where we can build some success by having some early victories. Once we've gone through a couple of these rounds, we can move on to the next step, which is improve company value. So how are we going to do this? We're going to prioritize 3 to 5 action plans that we can complete within 90 days. We call those 90-day sprints. At the end of those 90 days, we're going to determine how successful we were. If the answer is we completed those, then we're going to move on to the next 3 to 5 action plans. If we say, well, we're not quite there yet, then maybe we need to add a little bit extra time. And we're going to run these in continuous loops until we're ready for the next step. So I have a picture of an elephant here. And what that means is when I have a big job at home, I tell my kids, how do you eat the elephant? And the answer is 1 bite at a time. Or in this case, it's 90 days at a time. All right, to dive into the de-risk factor. So one way we can reduce owner dependence, we do that by developing a strong management team. Next, we can reduce concentrations. And this is customer, supplier, maybe even product line. Next is to improve our process and procedures. So the first step will be to get them written. Next step is to review them and see if we can find areas for improvement. And that's also an area that SVA can help with as a side job. Next is a history of clean financial statements. We'd like to clean up those financial statements 2-3 years in advance, right? So what do I mean by that? Well, if you're an aggressive taxpayer and you're pushing through some borderline business / personal expenses, we kind of want to get rid of that a couple years in advance. We can explain that away through normalizing our income. But if I was a buyer and I thought, well, this guy is maybe willing to get a little bit of gray area with the IRS with potential ramifications of that, maybe he's going to do the same with me. Next is to reduce legal exposure, right? So we try our hardest to resolve any sort of disputes that are out there. If we have copyrights or patents, we want to make sure those are up to date, that we have all that intellectual property protected. Next is to improve companies' culture. We said before, we like long-term happy employees. So maybe we employ some sort of incentive plans on longevity or production. Find some ways to make sure our employees know that we like them. All right, then the last one is tax structure. We want to make sure that we're in the best tax structure possible to save taxes, both during the years that we're operating and when we sell. So after we've been through a few rounds of de-risking the company, then we can move on to the increased value. So one of the ways that we can do this is to increase top line sales. But the truth is that we need time for this. So we need time to develop a marketing strategy, time to implement that, and time to see the results of that. Next step is to improve EBITDA. We can do that by cleaning up some of these questionable expenses, looking for waste. We saw before in the last webinar the power of improving your EBITDA and improving your multiple and what that can do to the value of the company. We can look for ways to increase recurring revenue and long-term contracts, right? So we can even out our income. That is a little more attractive than maybe the hills and valleys that you may see with some sort of seasonal work. So if we could kind of smooth that out, that would make the company more attractive, improve economies of scale. Maybe this has to do with the purchasing power and how we do our purchasing, looking for waste and cleaning that up. Finally, to build a repeatable, scalable model so that we can open up the next location across town or in the next city. So we have the blueprints to easily do that. All right, so after we've been through a couple rounds of the de-risking and building value, it's time to go to the next category, which is decide, or it's really measure, then decide. So is the company ready to sell? Have we improved our EBITDA? Have we worked on our 4 C's intangibles to increase our multiple? If so, let's revalue the company and see where we come up. If we shrunk that wealth gap, then we can determine, hey, maybe it's time to sell, or maybe now that the company is more profitable, you're having fun and you can keep it a little bit longer. If the answer is no, that gap is still too large, then it's time to go back to stage 2 and go through those 90-day sprints to improve the value of the company. All right. This is part of the de-risking. This is reducing owner dependency and operational risk. So I'm going to dive a little deeper into that. So this is probably one of the biggest killers for valuation for the company. The company is just too dependent on the owner. And so this is called a lifestyle company. And basically what that means, if the owner wants to live the lifestyle that he's doing, basically he can never retire because he's never going to get as much out of the company when he sells it as he thinks it's worth. So this company is going to score very low in the attractiveness scale, which means it's going to require a lower multiple. So I have two examples here. Both of them have the same EBITDA of $1 million. The first one has the intangibles high, so it's got a score of 5. So that company value is $5 million. The second company has the same EBITDA of $1 million, but is dependent on the owner, so its multiple is low. So we can see the value of that company is $1 million. So the difference here is $4 million. So what is this company worth without the owner? Not as much as if it was not dependent on him. All right, so what does owner dependency look like? It looks like all the revenue is tied to the owner because he has all the contacts with the customers and maybe with the suppliers. He runs all the jobs because he has all the expertise. There's processes and procedures in place, but maybe only he knows them and maybe they're not efficient. So how do we get out of that? How do we remedy that? The answer is building a strong management team, right? Creating a team approach to dealing with your customers and suppliers, letting them know that it is more than just the owner that you can deal with to get an answer done, right? So it's delegation of duties, documentation of the process and procedures, it's training and developing your staff. And at SVA, we're really big on this here. So we call it training your replacement. And so if I want to move up the ladder, I need to train somebody to take over the duties that I'm doing now. Otherwise, I'm going to do the duties above me and the duties below me and the duties below that. So it's just good practice. So the true test is are you able to go on vacation, or is the company going to melt down if you're gone for a week? If your answer is I can't take a vacation because what is the company going to do without me, then we need to start working on some of these things. If you go on a vacation for a week or two and the company's can still stand, then you are ahead of the process.
All right, now that Craig talked about we don't want to rely on the owner, we don't want to depend on the owner. Well, who are we going to depend on? So that's really going to be our leadership team. So a strong leadership team really equates to value, stability, easier transition. Buyers want continuity, confidence, so they don't want to just rely on one person, and that one person is the owner that might leave. So the leadership depth reduces transition risk. So we talk a lot about risk within this presentation. And the reason we do that is Craig just showed us. You go from a multiple of 5 to a multiple of 1. That really equates to real tangible value. So a buyer wants to evaluate who's staying within a transition and who can they rely on. So they want confidence that the business can operate without the owner. That really relies on a strong leadership team, which reduces that transition risk. Within that, you need defined responsibilities to improve operational continuity. So, Joe and John aren't doing the same task differently. Joe and John are following the procedures that we have as a company. And so anybody can step into that and easily know that there's documented procedures and they're all doing the same. And then leadership depth supports long-term stability and growth. So really need to look at, hey, what's my job descriptions? What's my org chart look like? And is it actually functioning like that? Or do we have some work to do? So we want to move from an owner-centered to management-driven company. I know some of you might be thinking, well, maybe I'm not quite ready to retire yet. So what am I going to do? Well, you're going to do all the training to get your management ready to do things like make key decisions and take over client relationships and help with the strategic direction of the firm or of the company and have more financial oversight. You might not hand over full financial statements to your leadership team, but hey, what financial impacts or what numbers can they impact? Well, they should know, hey, how are we doing on these? Because they're pulling levers to try to do that. Transition happens over time. So like Craig said, hey, you might need 5, you might need 10 years. It depends where you're at along this journey, but you want to gradually delegate this authority, right? If you're just have a new person coming into leadership, right? You need to teach them and help them along to make sure that they're making good decisions on your behalf for the company. So you would want to empower department leaders. You want them actually to be acting as a leader within the company. Document responsibilities and processes. So a lot of times as you're going through this, nobody wants to step on each other's toes and not necessarily clear who's responsible for what. You want clear lines to tell them specifically what their responsibility is so they can act on it and they can be held accountable for that. And then you want to shift key relationships to this leadership team over time as they're ready. So by doing this, you're building a sustainable management structure. So you're creating these documented organizational structure. We know what we want our structure to look like, and we're going to take these steps to get there. Clearly define leadership roles and responsibilities. So letting your leaders know this is specifically what you need to do. This is how we're going to hold you accountable, and this is what you're going to be accountable for. And then you want to develop succession plans for critical positions. So for critical positions, we never want just one person to be able to perform in that area, because if that person's out, then you can't act quickly. So to de-risk the business, you want to have a succession plan or a backup plan for those critical roles. And really importantly, if you take one thing out of this, is this all takes time. It takes actually a lot of time, usually way more time than you ever anticipated. So for the leadership development, that takes just as much time to cross-train leaders and key employees. Then you want to invest in leadership development early. So you really want to identify, hey, who are my leaders? If you haven't already identified, you want to identify them early and give them the specialized time and attention and training that they need. And then you want to make sure that you're cross-training your leadership team, because that decreases your risk and your exposure. And retention planning matters. So a lot of times I hear from people, well, I tried that and then, so-and-so left, right? We hear that all the time, or we've experienced that, which is frustrating. So what measures can you put in place to retain your people? So there's retaining your people, while you're growing the business, while you're going through these 90-day sprints. Then there's, okay, we want to retain our key people when we go through a transition, but then they're also valuable within the company. So your buyer wants to retain these employees post-transition as well. So you can look at in different planning measures are beneficial in different areas where you are at along that spectrum, but you can look at incentive compensation, phantom equity plans. So, hey, if they're going to help you grow the business, they're going to participate in some of that growth. Retention bonuses, post-transaction, we see those a lot. And a lot of times the buyer will be part of that. They might actually even require it. And then career development opportunities. So going through this, relying less on owner dependency really gives them a lot of opportunities within the company and within their career, which is really exciting. And then now that we have, we've talked about getting our people ready, we also need to get our financial and operations ready, which takes just as much time. That also impacts the valuation. It impacts buyer confidence and the efficiency of getting a transaction done. So buyers want disciplined reporting. They want scalable operations. And ultimately, those two things signify lower risk to the buyer. So financial quality matters. So a lot of times we'll be talking with a business and they have cash basis financial statements, for instance, or they don't have consistent financial reporting. And this is one area that we'll jump into real quickly, because as Craig said, you want 2 to 3 plus years of financial statements that are reliable and accurate to help with the transaction. So buyers prioritize transparency and predictability. So, if your financial statements are going up and down and up and down, and you can't see a clear path or understand why, it might tell me, hey, these financial statements, well, first off, maybe the business is cyclical, but you would be able to see that. So maybe these financial statements aren't accurate. You want strong reporting builds credibility. So throughout the sales process, you're going to do due diligence. And within due diligence, they're going to look at, all your activity, all your financial statement activity. So as they go through this, when they provide you a letter of intent, that is based on, what they perceive as a good company. So as you go through due diligence, if you're losing credibility within that process, it could impact your sales price because it could impact that multiple or other things. So you want to be ready that you can show a buyer, hey, we're credible, our financial statements are credible. Clean financials support smoother due diligence. So due diligence is a is an intensive process. So if you can get through that cleaner and quicker, you're going to save a lot of time and resources on your side. And a buyer wants reliable cash flow, so that improves the valuation. So if you don't have reliable cash flow, a lot of times I'll look at financial statements and be like, "Hey, this doesn't make sense," or this business is losing money," and then somebody might, or "Why are your cost of goods sold so high, or your labor so high?" And then somebody might tell me, "Well, our inventory didn't get adjusted," or we had 3 payrolls in a month. Well, if you're on an accrual basis, that shouldn't impact that number. So then it tells me that these financial statements and the cash flow is not reliable. So common financial readiness issues. So incomplete or outdated statements. So, hey, typically we say by the 15th of the following month, you want to have financial statements to rely on. If you're, maybe getting 6 months, maybe just looking at them annually. Also, if you're only focusing on the income statement and not the balance sheet, that's a problem as well, because throughout due diligence and the buyer will focus on both, and both are equally as important. Weekly, monthly reporting discipline, or no, or lack of monthly reporting discipline. So you really want to, on a monthly basis, have a month-end close process and follow that every single month. So every single month, your financial statements are standalone. And at the end of the year, you really have minimal annual adjustments because your monthly financial statements were accurate and appropriate. Personal expenses within the business Craig had covered. You really want to identify what those expenses are, and maybe eliminate them if that's possible. The other thing throughout this planning, if you are relying on expenses through the business, you have to think about, okay, post-transaction, you're going to need to cover those expenses somehow. Inconsistent profitability. This could be, hey, you have a seasonal business, but some of it might be, hey, our financial reporting isn't great. If you have a seasonal business, Craig talked about, well, there's ways, that maybe you could smooth out that revenue stream, which will result in a higher multiple and higher purchase price. Or weak internal controls. So that's going to be really important because the buyer is going to look at, hey, what controls does this business have? Because they want it to be standalone. So if you have strong internal controls, that increases their ability to trust your financial data. And then you need to normalize the financial picture. So as Craig talked about, you need to get to what's called a normalized EBITDA. And so within that normalized EBITDA, there might be one-time expenses. A lot of times you might have a large one-time repair or something of that manner. You're going to want to keep track of that. And when I work with my clients on this, we really go through and we really try to find like what wouldn't be reoccurring, because what we need to get to for the valuation is what is a recurring stabilized EBITDA number. Then you also have to evaluate the working capital requirements. You might need to leave a certain level of working capital within the business during the transaction. You need to look at your customer profitability and your revenue concentration risk. So you might have, let's say you have a revenue concentration risk. There are things that you can do. It's not, okay, I shouldn't work with this customer because they're 40% of my income. No, we should grow the business in another manner that reduces that risk of that specific customer. And then operational readiness supports scalability. So we talked about like, hey, if you have a business that's ready to go in the next market, then you're scalable, and that's going to really increase your multiple or the price that you're going to get for your business. So some of those priorities are standard operating procedures. Again, Joe and John are doing the same task the same way. Standardized workflows and reporting. So we know every month that we need to do this. We have a month-end close processes and procedures that's documented that we follow. Implement KPI dashboards. So you know, hey, this is what we're looking at, this is what we're measuring, this is how we're performing. A buyer would find value in that data. Strengthening technology infrastructure, and then review cybersecurity controls. So really making sure from a technology component that you're secure is very beneficial. And the benefits are, hey, we can increase scalability, right? Like we're ready, we know what we're doing, we know how we do it. Now let's just go and get the work. Reduce operational disruption. So a lot of times if you have two people doing two things different ways, then you always have to think, okay, well, who am I doing this for? Now it's, hey, every component behind a project can do the same exact thing no matter, what job it is. It's going to result in faster diligence process. Like I said, the faster you can get through due diligence, the better off the transaction will be. And ultimately, it leads to higher buyer confidence. So, that LOI that we originally received, we sell for that price and we have minimal negotiations back and forth. So he talks a lot about, okay, well, you have to get through this due diligence phase. What are some of the documents that people are looking at within that due diligence phase? They're going to ask for financial statements. A lot of times they'll ask for all transactional detail. So they're going to see the ins and the outs of all your general ledger accounts. Tax returns, they'll also do tax diligence. So they'll ask for supporting statements and calculations behind your tax returns. Contracts and agreements, a lot of times, or sometimes I have clients that come to me and then, we'll talk about their contracts, their customer contracts and agreements, and they don't have them, or it's a handshake, or it's a verbal. And that's not as valuable to the buyer because there's no contractual obligation there. So a lot of times we would look at, hey, can we get those agreements, those handshake agreements on paper? HR documentation, compliance records, legal documents. So, really the nuts and bolts of the business they're going to dig into. What are the advantages, or why do you want to do? I a lot of times call this a pre-diligence stage. Why do you want to do pre-diligence? Well, it's going to really help you get through the actual due diligence faster. There's going to be fewer surprises during the negotiations or adjustments, improved credibility with buyers and lenders, and really reduce transactional friction. So, hey, what we said happened is what happened, and our supporting documents tie out to that. So how do you prepare your business for future transition opportunities? So really you have to look at, well, what are my transition opportunities? Here I listed out a lot of different paths that you could go down. The reason why you want to prepare so soon is it gives you the ability to choose what path is best for you, what path is best for your business, what path is best for the marketplace. If you don't prepare, you eliminate a lot of those choices and the market will choose for you. So timing is rarely fully predictable, right? So you can control your business and your internal factors, but there are significant external factors that you need to take into consideration. Interest rate is a big one, right? So your business can only support so much. And if more of that's going to interest versus principal, well, then that's going to impact how much a buyer can pay for that. Tax law changes. So we try to reduce taxes within this. If there's an upcoming tax law change that you need to get ahead of, if your business isn't ready, you're not going to be able to. Economic cycles. So you want to sell when the economy and your business area is at a high. Industry consolidation, you have no control over this, but when these industry consolidations happen, it typically means that you would get a premium multiple. So if your industry is, going through a consolidation and you're looking to sell, you want to participate in that consolidation. And then market demand shifts. So, hey, this was a stable business and now it's booming and I'm able to sell it. You want to be ready for that. So it enables faster response to opportunities. It reduces any pressure of any unexpected events. Like you're in this, you have the steering wheel of the car. You're in the driver's seat, which makes it way more fun and beneficial. And then it improves strategic decision making because you can make strategic decisions. The market isn't making those decisions for you. In preparation improves current performance. So I kind of cringe when I hear people say, I'm not ready to do that yet, to transition to my key leadership team because I want to be here for a few more years. Or what am I going to do? Well, you're going to develop those key leaders, and you're going to be really valuable as a business owner in that stance. Because let's say if you don't transition for another 10 years, your business is stronger, it's more profitable, your people are stronger, and you've set your business up for scalable long-term success. So what are the factors that drive value? So really looking at what are characteristics of high value businesses? Stable recurring revenue, diversified customer base, reliable management team, documented systems and processes, predictable cash flows, and strong operational discipline. So you should look at these bubbles and really challenge yourself. How is my business in each of these categories? When you do that, that's going to tell you, hey, this is the area that I should put more time and attention to make sure that I have a high value transferable business. And then let's not forget personal readiness matters too. So you really need to take and make sure that you've done everything that Craig talked about to make sure that you individually are ready, you know what you have to sell your business for, and then that'll all translate into a happy retirement.
Thank, thank you, Nikki and Craig. That was a lot of information. I hope everybody got a little bit of insight into the importance of planning. After all, I always say a succession plan without a plan is nothing more than a liquidation. So we do have an assessment that we can provide to people if interested. It's a questionnaire that will come back and summarize where your risks are or where you need to focus more on a succession plan. If you email any of us on the panel or any of us in this webinar, we can get you that invitation to take that assessment and share the summary with you. And we hope that you join us for our next webinar on June 16th, where we will continue to discuss options for a successful transition. So thank you again, everyone, for attending, and have a great rest of your day.